Robschild. No investment advice. Welcome to the show, where we view financial markets through crystal ball gazing. Today is Tuesday, September 10th, 2024. Today's episode, we're going to start with the 3-year, 5-year Treasury Reversion. Notably, last Friday, the 2-year, 10-year uninverted. This reversion often spells out the beginning of a recession, especially when it's the short end of the curve that is dropping below the longer end of the curve. As it is, the Fed funds rate is expected to drop to a target of between 2.75 and 3% by July of 2025, according to the Fed funds futures. And so we are in the case where it's pretty obvious to anyone that follows any charts or any markets at all that this is where we're headed, straight into a recession. And another important part of the curve, less important for most people, but I find it notable only because I look at the whole curve every day. And the 3-year, for the first time today, as far as I've noticed, is finally actually lower by 0.01% than the 5-year. So we are starting to see these dots dropping, and so the next one is the 2-year below the 3-year, and so on. The other notable one that people usually pay attention to is especially the 3-month and the 10-year. When that happens, it's usually like we're already like extremely obviously in a recession. That's when the news has already been talking about, everybody not being able to get work and companies going bankrupt and all sorts of terrible things happening. So we'll get there when we get there. Importantly, tomorrow CPI comes out. Markets didn't really do a whole lot of interesting things today. We're all really waiting for CPI to come out tomorrow, and then PPI coming out on Thursday, which could influence markets. Sort of the way I see the markets in general right now is that there isn't really any such thing as good news. It's typical in like normal times, good news is good news, bad news is bad news. But then you get to this part of the cycle where the yield curve is inverted and the Fed tightens, trying to strangle the economy. And so once it succeeds, once there's evidence of it strangling the economy, so jobs are cooling down, inflation is cooling down, that's like sort of a good thing for markets because like the value of your stocks can go up, at least like sort of for a little bit until they don't anymore. And then you eventually get to the part where people start saying more frequently that good news is good news again and bad news is bad news again. So a really low CPI print, for example, would be bad news. It would mean that the economy is slowing down too much and the Fed is clearly behind the cuts and they didn't do enough early enough, suggesting business will slow down further than they want to. And then the thing is, so my whole take on all this is that really almost all news is bad news. The only way we could have good news, the way I see it, is if inflation, like CPI coming out tomorrow, it's like 2%. But then a month from now, the same report comes out and it's still 2%. It just stays 2% forever, exactly the target that the Federal Reserve wants. We all know that that's not how this plays out. You get a trajectory and you just keep going that way until until the ship finally starts turning. Like, think of it, the Fed is just turning the ship the other way. They're turning. In 10 days from now, it'll be September 20th is the meeting. That's when they turn the ship. And then it takes like a year for the ship to start actually moving that direction. And so the way I see it is that there's not really any news that could be good news at this point. For me, all news is bad news. Unless you have treasury bonds, I guess, or cash right now. I think those are decent places to be as far as, financial markets go. So then the daily reminders, 2-year, 10-year Treasury yield curve was inverted for over 2 years. This hasn't happened since before the Great Depression, signaling that we may be headed into an actual depression here, not just a recession. And we had reversion on last Friday, on the 6th. Another daily reminder, the SOM rule was triggered, suggesting that unemployment rate has been rising at an unsustainable pace. This typically also marks the beginning of a recession. Also, I added to my daily reminders today because I think this is incredibly important. The S&P 500 currently has a PE of 29 without even going through a major earnings contraction. Sometimes you have PE ratios going way up because the earnings are temporarily, suppressed or going down. And I mean, you could argue maybe they're suppressed, but they haven't really contracted, which means to me that the price is simply way ahead of itself. And so, it's not abnormal for the S&P 500 to drop to a PE ratio of 15, which would suggest a correction of about 50%, and if you get earnings contraction on top of that, it could be more than 50%. And if you expect the PE ratio to get down to its historic lows of around 7, we're looking at a potential 80-85% correction in the S&P 500. But who cares? We're sitting at all-time highs, like nothing's wrong, everyone's happy. But I'm telling you, it's a very expensive market. One thing that Benjamin Graham says is that stocks are a voting machine and not a weighing machine. And I recently came across an addition to that, and I'm not sure where he says this, but it was attributed to him and it makes sense. It's short-term versus long-term. The key is that in the short term, it's a voting machine, but in the longer term, it's a weighing machine, because eventually you do get that reversion. Eventually, the market has to wake up to the reality of its situation. And, for the S&P 500 to be this expensive right now, longer term is, either the earnings need to just go way, way up. They need to double without the S&P 500 price going up in order to have the price go back to a normal price, or we need to have the price of the S&P 500 drop one way or another. Reversion is real, and the weighing machine eventually wins. So with all of this in mind, my crystal ball reading suggests that the market crash right now continues, and also that the Fed will not cut fast enough to save the economy. On to some charts. This is the S&P 500. I've been talking about this being a head and shoulders top on the S&P 500. This is more obvious. It's a more obvious head and shoulders pattern on the NASDAQ. Some might even consider, one commenter said, this could be seen as a double top, and that's also true. And with an M pattern like this, all you need to do is close below the bottom of the M for this to continue being very bearish and go down for the real correction phase here. In the short term, it looks like we're headed down to, if you want to use this trend line here, which actually goes further out, by the way. It goes to the top of, let's see here, this goes back to July of 2023, the top there, bottom there. These trend lines are powerful psychological things. But today, like I said, we're waiting for CPI to see what's CPI going to do to the market. And again, the way I see it is that all news is bad news. I don't see how the market could interpret whatever comes out tomorrow as being good news. We're just at that part of the cycle. Same in the NASDAQ, the triple Qs. This is the head and shoulders top I'm talking about. This head and shoulders is still in play. It looks like it's still developing. Again, this is, you can't really count this as a head and shoulders top, by the way, until you actually break the neckline. And then ideally you actually confirm it. But, with my crystal ball and all, and the timing of this, with what's going on with the cuts and how, typically right when the Fed starts cutting is like the top of the market. It almost always plays out that way, it seems. So it just makes perfect sense for this to continue down. HYT going up. This is junk bonds again today. HYG, basically sitting at not all-time highs, but highs of most of the recent past. This has to do with the Treasury yields dropping, which helps support the value of these junk bonds to go up. When they move in sync with each other, they're just saying, yeah, we're not really, the credit spread between more risky and less risky is not really moving. It's staying in one place. I see this as the best trading opportunity. I own puts on HYG right now because like I said in yesterday's show, where we are right now in the cycle and seeing how tight credit spreads are, they're very tight right now. If you saw the chart I shared yesterday. And again, there's two reasons I love this position on puts on HYG. If credit spreads widen, then HYG, the value drops, making put contracts worth a lot of money. And then if TLT goes down, if the Treasury yields go up, then it has a double way of hurting HYG. First of all, with the whole curve of credit spreads, the yields moving up, the value of junk bonds will drop. And then as conditions are tightening, if yields go higher, it puts more risk on credit spreads widening anyway. And so this is really one of those situations where I see it's like I'm the one playing, heads I win, tails you lose with the market right now as far as being bearish on HYG. I think this is the perfect time to be very bearish on junk bonds. Very importantly, keep your position size in check. Be comfortable with being wrong, and remember that I'm just a guy with a crystal ball and I'm not giving any advice. I bring this chart up pretty much every show, but I just think it's because it's important, and we're headed into more expected volatility on the VIX futures curve. Should be lower on this side, higher on this side. October is still highly elevated above all the way out through February contract of this. The VIX being at 19 today is still very elevated. This hasn't cooled back down to these lower levels that we saw before the yen carry trade blow up. We were around 12, 19. It's nowhere near the 65 level that we got to recently. Again, spikes like that don't happen often. The last time we saw a spike like that was literally COVID, and then before that the great financial crisis. So those are historic days, but we don't ignore the fact that the VIX is still highly elevated here. If you've been following the show, you know that I am about 56% in long Treasury bonds. TLT is the most popular fund for that. I prefer ZROZ and TMF and calls on those two. So yeah, we had another very, very bullish day today. I'm actually surprised at how this is just, skyrocketing up while we're going into the CPI report. Nothing's really changed, but it seems like the long bonds are getting popular, at least right now. And this could be a little bit of short covering here, helping fuel the movement up. Like I said, it was on Friday, we had a crazy candle. It was a heck of a battle. It opened and closed exactly at the same spot, and we had it was a very large wick. So it got all the way up to $100.80, all the way down to $19.20, closed exactly in the middle. Huge battle. And then the bulls, yesterday I said bears, the bulls took over and just drove it up, and then drove it up even further today. So bonds are getting a big bid here. And on the opposite, its upside down chart, the 30-year bond yield has been just like really dropping to a similar level, that we saw at the end of 2023, being at 2024, you would kind of expect this to at least bounce here. So TLT really, this is a major price trend line. I expect people to be selling treasury bonds here. I won't be, because I think that the slowdown is going to be more severe than other market participants still. I also think that rates are still high, and I'm not selling long bonds until they at least get down to what I consider to be at least a normal level. But I may ride it out and do some kind of trailing stop loss at some point on it, especially when we get closer to 3% yield. Obviously, it does have to do with oil plummeting. Gas should be continuing to get cheaper here. Again, I think it was last Tuesday, we broke major trend lines to the downside, and we've just been falling since then, suggesting that the oil producers are fighting to sell oil. People are not buying as much oil. This is one of those major economic indicators too, that things are really slowing down right now. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.